Good morning. Today is Wednesday, July 12th, 2023. This is the Arlington County Board of Equalization hearing. 3 cases on the agenda. First case is RPC 34027-562, and we have Mr. Armand Yanani as the agent to tell us about this property. You can start with your 8 minutes, sir.
Thank you. My name is Armand Yanani. I am a representative for the owner with Ryan LLC. Thank you, everybody, for your time this morning. The subject property is the Renaissance Arlington Capitol View at 2800 Potomac Avenue. The 2023 proposed assessment is $76,133,100. The indicated assessment that we've arrived at is $54,819,000. If I can flip everybody to page 2, I have included some notes and commentary there, just discussing the hospitality market as the date of valuation. Just a few points that I would like to reference. Number one, I think everybody has seen, this is apparent, the hospitality industry was the hardest hit sector from the COVID-19 pandemic. Some properties may never reach pre-pandemic levels based off of the indications we're seeing in the market. The current revenue at the subject property is still down almost 24% from 2019, which is very considerable and not necessarily what the larger market surveys indicate. And it seems to be a theme within the DC region. Second, which kind of ties into this, the Washington, DC hospitality market has been highly reliant on group travel to maintain occupancy levels, especially relative to other markets in the US. The shift to remote work and virtual events as a result of the pandemic may lead to the fact that demand will never reach the pre-pandemic levels that we are looking at right now. This is especially prevalent with hotels that have 300 plus keys. I've included a few articles from CoStar discussing this in the back of the packet, which I will reference if I have time. And then finally, I think it's worth noting that with the Amazon HQ2 on pause, it is not quite clear where or how the hotel owners are going to reach their pre-pandemic levels of demand, especially with the decreased group travel and business-related travel. There's a high correlation between midweek transient occupancy in the DC region and office utilization. The correlation coefficient CoStar found in their study was 0.92, so almost a 1-for-1 correlation. And as we know, with how the office utilization rates have dropped since COVID and continue to remain low, we believe that this is a impact that is going to extend beyond the pandemic, due to the shift to the hybrid work schedules in DC's biggest industries, including government, tech, finance, consulting, etc. So with that, I'll flip everybody to page 3 of our submission, where we have our income approach. Off to the left, we have the recreation of the 2023 Arlington Department of Real Estate assessment inputs. To the right of that, we have our revised approach for 2023. And for the columns very far off to the right, we have the trailing 4 years of financial history at the property. So starting with the revenue, so in 2022, the total revenue was $20.8 million, which, as I mentioned earlier, is almost 24% below the 2019 levels of $27 million. The Department of Real Estate assessment is assuming a $22.7 million revenue for 2023, which we felt, a nearly 30% increase to be kind of aggressive considering the state of the market and the lack of any concrete indicators that there will be such a recovery. The way we're looking at it is that as of, the calendar year 2022, things began to normalize following COVID and, began to reach what we would call maybe a new normal. And there's no, direct catalyst that we're seeing for such a large increase in revenue from 2022, considering everything was open. There was no travel restrictions. The vaccine rollout was successful. Consumer confidence, is quite high. There's not much, hampering the demand on the COVID side. So what we're seeing and what we believe is, that essentially these hotels are going to have a very hard time reaching these pre-pandemic levels of revenue. So we decreased the revenues by slightly to for rooms to 12.8 million, we assumed an average daily rate of 195 with an occupancy of 60%, giving us a RevPAR of 117, which we think is a reasonable assumption compared to 2022, where the ADR was 191 with a 57% occupancy. It's not clear where the county got their inputs. They do not give a average daily rate or occupancy, so we weren't really sure, what basis to go off of. I think they do give the RevPAR on the worksheet though, so I guess we could assume what they might have, been looking at. The big issue with this one, and this will be a theme for, I think a lot of the hotels in the county this year, is the total expenses. The county is assuming expenses that are, quite low compared to what's actually happening in 22. This specific example is less extreme than maybe some others we'll look at today, but in this case, we increased the operating expenses to the actual 2022 ratio of 71.3%. We felt that the assessor using a total expense of 15.2 million was quite, low compared to the actual 22 expenses of 14.8 million. So, assuming a nearly 3 million or 2 million growth in revenue while expenses only increased by like $400,000, we felt was, there wasn't much support for that. So we felt it was more than reasonable to ask to use the 22 actual expense ratio of 71.3%. Another issue is that the assessor is using a 4% reserves at the property. The 2023 guidelines indicate a 4.5% reserves for full service hotels, which is typically what the county applies. They're applying 4% here because I believe that, is what the owner has reported as of pre-COVID. And as a result, we think that this hotel should be applied the full 4.5 reserves universally as other hotels receive in the county. Additionally, we think it's also worth pointing out that the 2023 guidelines operating expense ratio is 68.2%, while the assessor is using 67%. We also feel it necessary to point out that the 2023 guidelines are still based on 2019 I&E data and have not changed since tax year 21, and they have not been adjusted to account for inflation or CPI increases. So we feel that this 68% is actually still quite low. Historically, the county has always used the prior second year. Like, for example, 2020, they used 2018 I&E data. Then 2021, they used 2019 I&E data. And then since then, it's been frozen as a result of COVID. And we think that at the very least, there's due to the, high inflation, there should be some type of adjustment made to these expense ratios as, it's a big issue in the market. And I do have some articles included in that as well. And with that, we make the, we do adjust the cap rate based on market survey, which is kind of less of an issue. And we think it's also, that's where we get our value of 54.8 million. And we think it's also worth noting, if we capitalize the actual 22 NOI, the indicated value at the assessor's cap rate, the indicated value is $58 million, still significantly less than the current assessment. And with that, I think that that concludes my time.
Perfect timing. Thank you. Okay, Mr. Chicas for the county, please.
I think we skipped over the first case. We're speaking now about the Renaissance, I believe. Renaissance, like Arlington Capital View. Yeah. So speaking of that, we'll kind of work a little bit different order than some of the comments made. On page 17 of 91, you'll see the email received from the agent for the owner indicating that the FF&E reserves are at 4%. 4% is what we used. I think we heard some comments about inflation, and cap rates should be modified to reflect those inflation rates. As I think we talked about a little bit in the briefing for the commercial team and Board of Equalization, we noted that inflation was actually down 4 months as of January 1st. Obviously can't speak about January 2nd and thereabouts, but as of the first day of the year, inflation was trending down. Cap rates. The board may or may not remember, we actually did change cap rates fairly drastically in the year 2021. Prior to 2021, and this was all due to COVID effect on the hospitality industry. Prior to 2021, full service was 50 basis points lower, select service was 75 basis points lower, and limited residence suites and lodging were all 100 basis points lower. So that was a direct reflection of what was going on with hospitality at the time of those valuations. We heard about uncertainty in regards to economic indicators, specifically in regards to Amazon HQ2. Those in the room, I'm sure, are aware that it's well along its way. They've hired 8,000 employees, and that park is open for business. 2.2 million square feet of office space, fully leased, owner occupied. It is true that the second component, known as Penn Place, has not yet broken ground, but as we understand, it will be breaking ground at the end of this year or early next. Again, we've talked a little bit about other economic indicators. We included them in the packet. I'm sure the board has heard it ad nauseum at this point, but we'll mention again. All of those positive signs as far as what they would call tourism economic indicators are all up for the county. Again, hotel occupancy is up over 56%. Rev per available room is up over 111%, and average daily room rate is up over 35%. We talked about airline traffic. Again, almost 471,000 passengers came through National Airport that did not come through in 2021. There's no reason to believe that these numbers would not continue to increase. That, by the way, was 16% increase over year over year. Again, no reason to believe these things would not continue on. We talked as well about the popularity of Arlington within the state. It set tourism records for the state in 2018, broke those records in 2019. First 2.5 months of 2020 was set to break it again. When you look at what the county has to offer as far as reasons to come here, it's not only what the county itself has, Arlington National Cemetery, Pentagon, etc. It's the proximity to the nation's capital without having to pay for the nation's capital. So the access through airport, through metro, through cars, etc., makes this, again, a very viable economic opportunity. And again, I think the hotels show that. When we talk specifically about the performance of the property, again, the board knows we tend to rely on the history. So looking at the summary sheet, again, we'll see that this property itself had revenue per available room increase of over 150%, occupancy of over 77%, room revenue of over 150%. There were some notes that we may have been a bit aggressive. We're 9% over what they achieved in 2022. I would say that's a low projection now that we know what they actually occurred in 2022. There's comment about the operating expense. We're 3% over what they achieved in 2022. And again, well within reason after a year of almost 840% NOI growth, we're modestly projecting 31%. Mostly importantly, I think when you look at overall year over year, last year's assessment compared to this year indicates a 3.2% increase. 3.2% increase year over year after a year of NOI growth of 840%. The agent believes that the property went down 26%. I just don't understand how that could be possible after, again, the year of growth in which they had. Again, when we look at the facts of the case, we look at the economic indicators, we look at the county's recognition of the cap rate. We know that inflation is actually trending down. We've applied the correct FF&E reserve per the agent and the owner. We do believe that the county should be confirmed at the revised value of $76,105,900. Thank you.
Thank you. Questions from the board? Mr. Penneran.
Yeah, this is for the county. You mentioned that the county used the correct FF&E. According to the guidelines, isn't it 4.5% that it's supposed to be?
No. So again, guidelines are representative of what we submit to the county. So it's just a sampling of everything that we receive. It's an average, if you will. It says what is typical. We still tend to operate off of what is actually spent or incurred by the owner. So the board may know that or not, but we'll go up or down. So if we start with the guideline and then we find that in fact they spent 6%, we'll apply that. But we do confirm with the owner what they actually spent as opposed to imputed.
So they actually used 4.5% in the last 2 years. Would that be the right way to do it?
If they had spent that, but again, I'd ask you to note that in the comments and C and E, those are both imputed numbers. Yeah, so we verified what did you spend. And I'd also point out that it's on the I&E. It actually asks you to list what is the FF&E and how's it calculated.
Thank you.
Okay, Mr. Metzger.
Excuse me. I have probably two questions for the department. Well, no, really one. It has to do with expenses. Hotels, you don't, and this is not criticism, just a statement. You don't list expenses like you do for hotels like you do for office buildings. It's much more generic. So I need help deciphering what sub-departmental and sub-unallocated mean. Sure. Because, and so maybe this help you target the answer. You project that revenue gone up significantly from 2022 to 2023, but the operating expenses far less. My guess is that hotels are very labor intensive, a lot of people providing a lot of service. So if there's a lot more revenue coming in, there's going to be a lot more people, but it's not reflected in the expenses. So that's where I'm coming from.
Yes, sir. So yes, so generically speaking, there's two categories. Well, there's three. There's also insurance and tax. But that's basically self-explanatory. Exactly. So departmental is just that. What is the what are the expenses that are necessary for the income stream to come in? The departmental income stream. So room, anything related to room. So your hotelry, your room service, bedding, etc. You'll get into salaries, commissions, reservation expenses, food and beverage, anything associated with the cost of that, salaries, again, bartenders, food preparation, etc. Telephone is going to be another one, and then what they would lump in as other. Anything other than that is what's called either undistributed or unallocated, and that would be all other. So the cost of marketing, your franchise fees, again, payroll, administrative payroll, operations, so repairs and maintenance, your utilities are going to be in there. So that number will tend to be a little bit more reflective of the income that's coming in. Your departmental, it's not that it's going to be a fixed number, but you're going to find that, especially when you look at the relationship between expenses and income on the summary sheet, you see that they're inversely related. So the smaller the amount of money, the more the percentage of the operating expenses appears. You'll see that, and again, then last year it was, 2020 was 146%, right? Operating expenses. Well, that's not possible. And 2021 is 105%. So the more they make, the less that percentage actually goes down. Especially as typical with full service, because they're making more money, but it doesn't necessarily grow that it costs them more money to make that money. It becomes more of a finite number. It's the diminishing return, whatever you want to say. But yes, there is an inverse relationship, and you'll see that again reflected on the guidelines, where they're reflecting an average of 68.5%, and we're at 67%.
Okay, thank you.
Do you have a follow-up question?
No, I just said anything.
Anything else?
Just wanted to make sure I get the column E right. Yeah, it says 57% occupancy, then it says 77.57. That's 78% occupancy for the rooms. Is that what that is?
57% occupancy, and it grew by 78% year.
That's the increase. Got it. Okay. The NOI that's at the bottom line of E is reflective of a hotel that's at 57% occupancy in 2022.
With imputed FF&E.
Okay.
Because that wasn't imputed.
And then actually, can I ask about the sale that's mentioned in here, 2021?
Sure.
Is that arm's length? Or was it the two properties together kind of sold as a portfolio?
Yeah, well, portfolio, it's two properties. This was sold by JBG, who was trying to get out of hospitality and into multifamily, or spend most of their time on multifamily. And then again, as we talked about this last year, I mean, this is almost exactly the idea of principle of anticipation. They bought this knowing that it would come back years to come, and it has.
Okay, any final questions? All right, Mr. Chikas, take a minute to wrap up, please.
Again, it's really just kind of hitting nail on the head over and over with this idea of the Met indicators we see for economic growth, especially related to tourism. Gate numbers are up at national. We have more people coming into Arlington. We see that reflective in almost all of our hotels, especially, and we didn't even focus on that. These three hotels that we're here today are located in between Richmond Highway on one side and National Airport on the other, within literally a stone's throw of National Airport. So well located. We see the growth year over year. We do believe that the modest 3.2% increase is prudent. We would ask the board to confirm $76,105,900
All right, thank you. Mr. Yanani, if you take a minute to wrap up, sir.
Thank you. Just to comment on the reserves, it is true that the owners currently report 4%. However, we feel that the county's aggregated market data for full service hotels, reflecting a 4.5% reserve is by that own definition, more reflective of the market and more reflective of what the average of what is applied to hotels in the county. So that's why we apply that ratio. And then additionally, regarding expenses, again, the county is using a ratio that's below their own guidelines based on 2019 INE data that has not been adjusted. So we believe that at the very least, it would be reasonable to use that 68.2% from the guidelines rather than the 67%. As we could see in 2022, it was 71.3%. Additionally, I know that things have gone up, but the question is from what? 2020 and 2021 were disastrous years for hotels. And yes, there's some staggering percentage increases, but they are still well below 2019 figures. And we believe that that is the more important story that's told here, regardless of how things are changing in the market and people traveling. The 2022 INE tells the story that is to be told at this hotel, not, larger market surveys and travel data. Thank you.
All right, thank you both. Okay, it's just among the board members.
I'm fine with the revised. I mean, the idea, the argument, I don't think is proven. The fact that, well, even though they said 4, guideline average is 4.5, or some of the, I don't think the argument was made.
Yeah, the only thing, and I'll go with you on that, Stephanie, but, I look at this and think, it's still a tough industry.
Mhm.
I mean, it's not back. I think it's going back to where the county has it, but I think it's not quite there yet. I mean, when I look at, column E, the operating expense, I think that's a pretty big jump when you look at the NOI for even the initial assessment and the revised. I mean, what I did, I don't know if I've got any agreement here. I took the columns, column G, the appellant's pro forma, and which I think is more, if you look at it, it's 200,000 higher than what it achieved in 2022, which is more in line of it coming back. But I went and to appease the county, I took out the 4.5% and put in 4, and capped it out and took out the $1,094,000 and ended up at $61,692,400, which to me seems more in line with where it's going. I think it's going back to 76 million, but I don't think based on 2022 it's
I
there.
think it dropped 15% valuation from 72 million to 61 million.
Did we hear the case last year? We did?
We confirmed it. And we reduced the other property next to it.
Where, Mary, I ended up at 63, 958, 837. But then my thinking was that we shouldn't necessarily drop below last year. So my thinking was to go with last year. I don't know if anyone agrees, but when you do the math, and I agree with you, Mary, I think the income is way overestimated. And I think when you do it the way I did, you end up at 63, but I don't think we should go below where it was last year.
I don't agree with that.
But I'll
Yeah.
defer to others.
Or is everybody else?
I mean, I think it should be closer to 2022. It starts with a 6, or starts with a 7.
I was a little surprised on the FF&E, and this is just nibbling around the edge, but it's only up 3.2%. I mean, I looked at this and said, oh, that's terrible. This is horrible. And then I look at the bottom line, 3.2%. That's completely reasonable from last year. And having said that, nonetheless, the department's very good at applying guidelines in appellant's favor, particularly when it comes to vacancy in hotels, retail and office. They say, okay, it's, there's 3 spaces in here and they've been leased forever. Nonetheless, the guideline says 5%. By God, we're going to give you 5%. I didn't see why they didn't do it here. It's niggling anyway, so I came down to a figure by increasing the FF&E to 4.5%. I came to a figure of 74,577,000. Again, the answer is 74 million. I'm not trying to get a question because I have the answer, but that's what it came out to.
Well, I made a couple of changes based on the guidelines. 4.5%, if we're going back to 2019, it comes to almost that figure, for $1 million on the $1,023,000. If we were to make just that change, the value comes to 74,774,900 after deducting the personal property. And the other changes increase the expenses also to the guidelines to 68.2. By doing that, final value after the personal property comes to 73,903, which is very close to last. And I will be making changes based on the current year's guidelines rather than just going back.
Yeah, I like that number. It's good.
Can you live with that?
Good logic.
Okay, Mr.
Based on the
Panorama.
expenses?
Yeah.
Okay, so I'll move to reduce the assessment to final value of 73,903,400 based on increasing the expenses to 68.2%.
Wait, I'm sorry, expenses to what?
68.2?
And then did you do something with the FF&E?
No,
You didn't change.
no, just the expenses.
So just the expenses. Okay, so we have a motion on the table. Do I have a second? Mr. Hoffman is a second. All in favor? Aye. Opposed? Okay, it's unanimous. The assessment's reduced to 73,903,400 based on an increase in the expenses to 68.2%. Thank you. Okay, moving along, I'm not sure what agenda Mr. Chicas is using, but along the agenda that we posted, RPC 34027-563, 2850 Potomac Avenue. Mr. Yanani, you can start with your 8 minutes and tell us about this property, sir.
Thank you. Starting on page 1, the subject property is the Residence Inn Arlington Capital View. This is the other hotel that was purchased in the same transaction. It is located at 2850 Potomac Avenue, right by the airport. And the proposed assessment is $60,806,000. Our 2023 indicated assessment is $53,194,000. I'm going to skip over page 2 because I believe I, touched on that during the first presentation. And I think that, all of the same concepts apply to this hotel. On page 3, we have our income approach with the same layout, the county on the left, Ryan off to the right, and then the trailing 4 years behind it. This one also increased about 3% from last year. And on this one, we had no problem with the county's assumption for revenue. It was a, pretty reasonable increase from what happened in 2022. The big issue we found with this one, and again, it seems to be a theme with these cases, is the expense ratio. This property is receiving a 55.5% expense ratio, which, to be fair, is in line with the pre-COVID, expense ratio. However, the big issue we have when looking at this is the county's total expenses are $8 million, $30,000, with, a close to $1 million higher in revenue. However, in 2022, the total expenses were $8.22 million. So we are assuming a nearly $1 million increase in revenue while dropping expenses by almost $250,000. We just don't see where the support for that is and, how that's logical. If there is a way to do it, I'm sure our client would be happy to, I'm sure they would love for that outcome, but it just doesn't seem like the realistic approach to look at here. So what we do is, for our approach, we use the county's revenue and we update the expense ratio to 60%, or $8.6 million, which we believe is a more reasonable increase relative to the revenue increase, proposed by the county. Additionally, we adjust the cap rate slightly from 8.1 to 8.2%. Again, not as big of an issue. We understand the market surveys are kind of subjective and that the county is bound by equalization for the cap rates. So that's not really, we understand how that is. So using that approach, we get an indicated value of $53.2 million after personal property deduction. We would like to point out that the NOI here is still down 25% from 2019, which again, even in 2020, there are many cases where that was the worst drop for many hotels across the country. And, if you look at the market surveys, that's the decrease that was seen, pretty universally. However, in this case, we're still seeing it down 25%, which arguably for other markets and other hotels is as bad as 2020 was. So a big decrease in performance that, the owner had not anticipated when they acquired the property. It's worth noting that if we capitalize the 2022 NOI at the county's cap rate, the indicated value is $51 million after personal property. So a lot lower than what we're asking for here. So we think that our approach is being very reasonable, with the main change again being the expenses being increased to above 2022, not below 2022. And it's also worth noting that the county's NOI is representing a $1 million increase from 2022. And we just do not see any support for such a large increase. Especially considering the county NOI of 5.7 million is pretty close to the actual 2019 NOI. While, I think eventually the hotel may get to this point, I think that what the county is doing here is, this is arguably a stabilized value that they're coming to. And, maybe they will get to this point in the future, but many other jurisdictions in the area are doing a similar approach, but they're also taking a deduction below the line for lost revenues or the present value. However, Arlington County is not doing this. So we believe that it has to reflect the 2022 actual financials, since there's no adjustment being made to account for the fact that this is a multi-year recovery it's going to take to get to the figures they're proposing here. It's not going to be next year, not this year, at the end of this year. So with that in mind, again, we believe that there should be a higher reflection of the actual 2022 financials, which we believe is the best evidence for the performance at the property, and definitely supersedes evidence, of market data and, travel metrics in the county. Because while all of those metrics may be true, at the end of the day, the I&Es we're looking at here tell a different story, and tell a story that people are not spending as much money on hotels as they were before the pandemic. I think a lot of that is driven by the midweek office, transient office occupancy, as well as the lack of group travel, business travel, I should say. And especially for hotels like this with 325 plus keys, which really rely on that group travel to reach their target occupancy levels. And again, a lot of those conventions and similar events are planned years out in advance. So we're going to see that it's not going to be an immediate return back to 2019. It's going to be very gradual and take a while for, the owners to get there. So again, while we do feel that eventually the hotel may get there, it's not going to be this year. And as a result, there needs to be an adjustment to better reflect what's actually happening. So that expense ratio is, how we believe that should be accounted for. And that's pretty much it. And again, kind of pointing to some of the articles while I have some time. I believe pages 6, 7, and 8, I have some annotated, points on the articles where they're essentially discussing what I've already stated about the group occupancy and the transient occupancy and the correlation to office, occupancy and all of that, and how it, is disproportionately affecting the DC market compared to the larger national, averages. And then additionally, I've included some articles further back on page, I think 30, where the increased operating expenses as a result of inflation become an issue for the property, for the property owners in the hotel industry. So there's some commentary in there about that. And, some of the bigger issues being utilities, payroll costs, et cetera. So again, we think that we just don't see where this expense ratio, is capturing the reality at the property. But again, that's all. We asked the board to, review that 2022 I&E, compare it to what the county did, and hopefully there's some type of, you'll agree that there's something missing here. And that's all. Thank you.
All right, thank you, sir. Mr. Cheekas for the county, please.
Yes, ma'am. And so if I heard correctly, last case, there was a request for the board members to adhere to the guidelines. This case, not so much. Last case, the problem with adhering to the guidelines is that in the last case, we actually over-projected operating expenses as compared to what was actually achieved. This case, when we look at what was achieved, we did not. We actually didn't peg it to guidelines. It happened to come out at 55.5%, which is guideline.
We were actually looking at what was achieved at the property in 2019, 55.9%, making adjustments slightly there. We do again note that the appellants, in this case, do not wish to use guidelines, which are in fact 55.5%. Again, we did note the correct amount of FF&E. Again, we did note that this property is actually within 6% of the occupancy achieved in 2019, grew by over 100%, almost 100% in 2022. Again, revenue per available room up 150%. NOI was up almost 2,000%. Again, this property was visited by, in the board hearing by the Equalization last year. We did note a sale of $74.8 million. It was reduced down to $59.2 million to be in line with the averages of the county. And again, I would point out that with our revision, we're at 2.7% increase over last year. There's been a lot of mention that we're trying to peg to 2019. I would point out again, we're a good bit below 2019's level. What we're trying to peg is that we saw the huge downturn in 2020. We saw an immediate increase in 2021 during COVID. This was before the idea that everyone could either get vaccines or not. By 2022, you had COVID fatigue. You either figured out you were going to live with it or not. You started to see travel. You started for sure to see a rebound to 2019 levels. There's a reason why they call it that Nike swoosh. We were projected to get a 3-year recovery period. We were in that 3rd year. We believe that all the metrics that we've seen that are called economic tourism indicators for a reason, because they reflect what's going on with the hospitality industry. It would be near impossible to have these gate receipt numbers that are coming through and pretend that they're not going to increase. If they do increase, it only makes sense that these numbers that we see for the properties in the county will continue to grow. We talked about the idea that there's fewer hotels in the county for people to choose amongst. So again, we've talked about the proximity to the airport. We've talked about its proximity to DC through Richmond Highway. We've talked about its proximity to Metro. We talked about its near 2,000% increase year over year. We talked about that it's an increase year over year of 2.7%. All these things being said, we do believe the county should be confirmed at $60,786,200. Again, a cap rate that's full 10% lower than what was achieved in 2019. So not at 2019 levels, but we do believe it will be achieved within this next year. So we do believe that the county should be confirmed at $60,786,200. Thank you.
Thank you. Questions from board members? Mr. Metzger.
I have an easy question for the appellant. Is this a full service hotel?
It is select service.
Select service. Is that a guideline?
What do you it's residence it's resident suites.
I know I've seen it, but I don't know.
So these are the ones that would have like kitchenettes.
Yeah.
It's not service.
The county classified as a residence suite, right?
That's right.
Yeah.
Is that full service?
There's a guideline.
So full service would be ones that you would have like banquet services, meeting space, etc. Full room service, but
And they don't have it.
space. Exactly. It's a certain amount of space.
So it's a
Select
tip
service-
down from that.
Exactly. Full service, select service, residence suites would be those which have kitchenettes, longer stay periods, business travel.
But it's the tick below the last appellant service level resident.
Yeah, I don't know if that's a typical or just a tick to the side.
Well, I mean, to your, because you have different guidelines for different kinds of levels of service. That's what I'm trying to get at.
Yes, it is treated differently than full service, limited service.
Yeah, it's less.
Other questions? No? Okay, Mr. Chikas, take a minute to wrap up.
Nothing to add.
Nothing to add?
No.
Okay, thank you, sir. Mr. Yanani, if you have anything to wrap up in the last minute?
Yes, thank you. So one, just to comment on the sale, we believe that, it was a portfolio sale and it was highly speculative, bought by an institutional buyer. We don't believe that it's, necessarily relevant in deriving the current assessment that's equalized, amongst the county hotels. And then additionally, to comment on the expense ratio and the commentary on the guidelines. So for one point, the guidelines are currently based on 2019 figures. And they have not been adjusted for inflation. And just for demonstrative purposes, I know that it's not a 1-for-1 ratio, but there has been 12% inflation from January 1, 2019 to January 1, 2023. So if we apply that 12%, the expense ratio would actually be 66.6%. Just as a demonstrated purpose to say that, what we're asking for is 60%. We believe it's reasonable. And then additionally, in the last case, we didn't use the guidelines expense ratio. We used a higher expense ratio based on the actuals. Thank you.
All right, thank you both. Okay, it's just among the board members. Where's everybody?
Yeah, I'll share
Mr.
my
Lawson.
thinking. The applicant has acquiesced in the county's estimate of revenue, which is the 14,469,474. And I listened to Mr. Chica's explanation about just because you got more income, it doesn't mean your expenses also have gone up. What I did is I took I assumed the income, because both parties agreed, but I took the actual operating expense that was listed in column E. I ended up at very close to last year, a little bit under 58,679, 726. And again, I don't know if we should lower it. I guess an argument could be made last year was high. So maybe just go again with last year's assessed value. So see if anyone agrees.
Anybody else? Mr.
I mean,
Romero?
last year and this year are pretty close. The county's reduced number. So I think I can probably go either way. The one thing, we've got a year now at 60%. We should probably see if that becomes the new normal. And from what I understand, talking to hotel operators that do residents in, is that if you can get the people for the long stays, your operating expenses go down relative to your income. If you're trying to get people to book one night at a time, which sometimes you have to do to fill up your occupancy, your expenses are closer to the limited service hotel, which
How do you
would be higher. How do you estimate it? I mean, you got to look backwards,
Yeah.
right? You got to look at what last year was. So that's where the guidelines can get tricky, because the only way they got to, 67% occupancy, in my opinion, is probably because they were doing one night stays or 2 night stays instead of the gold standard is get somebody in there for a month and then you're not turning the room. Right.
Yeah.
So that's where most of their expense is. So, I mean, the long way of saying it, I think we're probably okay with either last year's or the revised number that's pretty close to last year's. I don't think go either way.
Yeah, I don't have as much angst on this as I did the last one.
Um,
Mr. Fennell,
No, I'm okay with the current.
the current or the
I
revised?
mean, the revised. Just to clarify, according to the county, there are 5 categories. It's way below the full service. It's full service, select, I think, and then limited, and then there's the residence suites.
Oh,
And lodging is the last one, which is.
Greg, are you good on the cap rate? Do you think the cap rate's appropriate?
Yeah, I mean, 9.293%. I think January 1st, that's probably a pretty fair cap rate.
The revision was for the, I guess
Oh, the appellant wanted a little bit extra, like another 100 or another 0.1 or something like that.
0.00.
Yeah. I'm okay with it.
Yeah, that's why I was asking.
no, it should be higher than the last appellant.
Yeah,
It
it
is.
I look at it like if you could probably get an 8 cap at 2023 pro forma revenue or NOI, and that's like 62 million, which is above assessment. So
Okay, all right, somebody like to make a motion?
I'll go ahead and move that we confirm the revised assessment of 60,076,200.
Do I have a second? Motion and second by Mr. Hoffman, all in favor? Aye. Opposed? 60,786,200. Same player, so we'll move along to the final case. It's RPC 34020-270, 2399 Richmond Highway. Mr. Yanani, you can start with your 8 minutes and tell us about this property, sir.
Thank you. So starting on page 1, the subject property is the Hilton Crystal City located at 2399 Jefferson Davis Highway. The current assessment is $54,376,300, and the 2023 assessment that we have indicated is $31,391,000. If I could point everyone to page 3, where we have our income approach. Again, I'm going to skip over, the previous commentary from other cases that, I don't want to be repetitive. So this one is different from the others in the fact that the assessment increased by 32% from last year, or $13.2 million, which to us was quite staggering, considering, the actual performance of the property. In 2022, the property achieved $3 million in NOI roughly, which compared to 2019 of $4.9 million is a 39% decrease. And if we were to capitalize the 2022 NOI at the county's cap rate, the indicated value after personal property is $34,300,000. So, far below even last year's assessment. So as a result, we feel that this increase is very high and not necessarily warranted. Looking at the, inputs for the county versus the actuals, the county is assuming 19.6 million in revenue, which we believe is a reasonable assumption given, the 2022 performance. However, again, keeping in mind that 2022 is still below 22% below 2019, so nowhere near the pre-pandemic levels of performance. And again, overarching theme, the expense ratio here is, to us seems very out of whack, a lot more so than the previous 2 cases. The county is using expenses of about $14 million flat, which is 71.4% of EGI. However, in 2022, the actual expenses were $15.1 million, achieving less revenue, or conversely, 81% of EGI. Also, comparing this to 2019, the expenses were 75.4% of EGI, so not much less than 2022. However, the county is opting to use 71.4%. We do not see where the support for this is. We feel that the expenses should be reflecting the actual performances of the property, as 2022 really is our best indicator for the new normal in the hospitality industry. There's no guarantee that even we are able to achieve expense ratios of 2019's level. So for that reason, we apply 80% even to the county's existing income. So that comes to a total expense of $15.7 million roughly, or roughly a $600,000 increase from 2022, which is still proportionately less than the increase in revenue. And with that, again, we do adjust the cap rate based on the RERC first tier Washington, D.C. survey at 8.2%. This hotel is getting 7.35% by the county. Again, not as big of an issue here as the expenses. And again, pointing out that even at the county's cap rate, 2022, the value comes out to $34.3 million. We're not saying that that's what the value is, but we're saying if we look at 2022, there's a staggering difference between that and what the county is coming in at for $54.3 million, which again is a 32% increase or $13.2 million increase from last year. We believe that this increase, is especially excessive, especially, comparing them to the previous 2 hotels discussed. And we think that, this especially, should deserve some consideration on primarily the expense ratio that's being applied. It's also worth noting out that this hotel, if I flip to page 6, where we have the December 2022 STAR report, if you look at the 3 kind of boxes at the top row under December 2022, you could see that the subject property is underperforming compared to the comp set pretty significantly. For example, the year-to-date average RevPAR for the comp set in the area is $114. However, this property only achieved about 96.5. So we believe that that is an indication that, this hotel is performing poorly relative to the market. It's not as desirable as other properties in the market. And as a result, we can see with what's happening in the 2022 financials, the story that's being told here is that this property is suffering, especially compared to its peers as a result of the pandemic. And we feel that the 32% increase proposed by the county is, far too excessive. And, we ask that our revised expense ratio be considered by the board. And again, referencing these articles in the back, there is market speculation about these increased expenses in relation to both inflation and basic, increases in different inputs of what the hotels, have to spend money on. So, we feel that, again, using an expense ratio below 2019 is just, not realistic. And again, believe me, the owner would love to achieve that. Don't get me wrong, but it's just not what's happening in reality, and may not ever happen in the future again. So we asked that at the very least, the 2019 expense ratio be considered, but we strongly feel that 2022 is a better indicator for the new normal in the hospitality industry, and we don't believe that the hotel will ever see a, expense ratio that's lower than 75.5% roughly. I think that's pretty much all. And again, just the increase here is what really is catching our attention. Thank you.
Okay, thank you. Mr. Chikas, again for the county, please.
Yes, ma'am. So again, we kind of talked back and forth. There's just essentially a disagreement on projections made based off of historical data. We know for a fact these indicators from tourism, from economic, Arlington's economic development, we know that they are true because we get them from National Airport. So we see that the numbers in 2022 are up, again, triple digits, near 670% increase in NOI due to a near 100% increase in occupancy year over year. So the idea is, I guess, it's just a matter of what's reasonable. Again, we heard a lot of talk in the first case about using guidelines. If you'll note, guidelines are at 68.2%. We're at 71.4%, so a full 3% over what was achieved. In this case, we actually did test the information we received because we noted the 150% growth in revenue year over year. We did think our 5% growth was very modest. We did note that the appellants used that as their projection as well. We did test that information, again, a bit more aggressive in what was possible at the history, going up to still within almost $1,600,000 less than what was achieved in 2019. We grossed up operating expenses, almost $1.5 million higher than what was achieved in 2022, 75% total revenue. We noted that it's still within 12% or so of what was achieved in 2019 with our, 10% or so of what was achieved in 2019 with our test. Therefore, we did recommend the revision. We look again, it is aggressive year over year, 32% change year over year, but again, contrast that with the appellant's recommendation of a negative 24% year over year. Growth of 667%, revenue up 150%. Occupancy up 94%, but the property should go down 24%. We don't believe NOI growth of 0.8% is realistic or near in touch with the realities of the marketplace. So even if you do believe that ours is too aggressive, we believe theirs is really not reflective of what's going on based on the metrics that have been achieved in the marketplace. It's not projection, it's fact. So, we would ask the board to confirm the revision of $54,356,900. Again, 12.26% below the NOI projection and 12.26% below 2019's level. So we agree, we're not at 2019's level. We do believe that we're very much on the path. We see the increases and all the correct metrics. We know that there's more people coming to the county. We believe that they're staying in these hotels. Located, again, this is very much in the same proximity of the other two. So in between Richmond Highway and, again, a stone's throw of National Airport. This is a full-service hotel, so they have more ability to help with those full-service customers that want a bigger name. Speaking of names, these are a proactive owner. I would note that this name change to Hilton Arlington National Landing was done with reason. They wanted to take advantage of the National Landing icon, the moniker, if you will. Apparently, the Virginia to do that. So we believe that's indicative of the owner's foresight, if you will, into the uptick at the property. All this being said, we do believe that the county should be confirmed at the revised amount of $54,356,900. Thank you.
Okay, thank you both. Questions from board members? Mr. Lawson.
Yeah, for the applicant, I'm looking at this miscellaneous revenue, and it went from I guess 973 to 2 million. What is that? What is that? Miscellaneous revenue, because that's a huge chunk.
That can be many things. I think a lot of it is probably, parking. I think there might be some detail on the I&E that was submitted.
I tried to find it, didn't see.
Can I speak to that, Mr. Lawson?
I'm sorry?
Can I speak to that?
Sure.
As far as we can tell, it is correct. It's actually, it looks like it was income derived from cancellations to some group travel.
Oh,
So in
okay.
other words, they usually set aside a certain amount, and if you don't fulfill that contract.
So it's kind of an untypical.
And if you will, you'll note that we
Yeah.
actually, we reduced that in our projection.
Any other questions? No? Mr. Chicas, if you take a minute to wrap up.
Just kind of harping on that, while again, it was indicative of some refund from group travel, I think that speaks to the group travel that's expected and is coming. Again, full service hotels that have the ability, they went through a large period of downturn where they're able to put money into their facilities, expecting this sort of upturn in travel as we've seen. We do believe that we've made the case, we tested the property, we've seen all the triple digit income growths. We do believe, again, within 12% of the NOI achieved in 2019, we do believe the county should be confirmed in the revision. Thank you.
Thank you. Mr. Yanani, if you take a minute to wrap up, sir.
Yeah. So what I would like to comment on is that, while again, a lot things have increased by, 3-digit percentage figures, as the county mentioned, the point is increased from what? It increased from a year in 2021 that had negative NOI. So it's kind of, we don't believe that those metrics are necessarily helpful. Additionally, we believe that I know that we're proposing a decrease from last year, which again, whether or not it'll actually land at that value, probably not. But the point is that last year we were speculating a quick return back to the pre-pandemic normal. However, now we have another year under the belt where we're seeing NOI 40% down still from pre-COVID levels. So we now have another year of data to take into account. And therefore, we're seeing that this is not going to be a quick rebound to pre-pandemic levels. What we're looking at is a new normal in the hospitality industry.
Okay. All right. Thank you both. It's just among the board members now. Where is everybody on this? Mr. Hoffman?
Yeah, the other two cases, it looked like, everybody's in agreement, there's probably a projected increase in NOI. It's just how much it's going to be next year. That's what we're trying to speculate on. This one is like 55% the county's got in there as the NOI increase from 22 actuals to 22 projected. So I'm a little kind of hesitant to accept that number without actually seeing that performance or something close to it. So I looked at it, if it was a 15% increase in NOI from 2022 actuals, even including the $2 million that they got for cancellations, I'm at like almost 40 million, 619, which is a little bit below last year. So I just don't see the 32% increase.
It's all coming out of expenses.
Yes. Yes. I'm full with expenses. I took column H expenses and capped it out and the achieved column E expenses. Both of them came out a little bit. Column E expenses being a smaller number was just a little bit under 2022 assessment. Taking the column H, which I think was an aggressive estimate from the appellant, way under. I don't see why we would not treat this hotel very, very much like the last two. All the service levels, the three of them are different. This is, it's a full service Hilton. This is a nice property. And I'm with Greg, I don't understand why it would be treated so much more differently. I'd rather have an increase in the 1 to 3% range like the other two were.
What's your bottom line?
Well, so I haven't gotten a figure yet to get into that because everything else got below.
Too low.
And it is absolutely worth more this year than it was last year in my mind, and I think everyone agrees.
What was your?
But I can look for another number to try to get us something solid.
39,
It's lower than,
a little bit.
did you do anything?
I didn't go as far as that. I increased expenses to what the county was using in the revised up to 75%. I used that number in the revision. And the final value after property and the FF&E of 4.5% is 46,092,000.
What did you change if you cut the test operating expenses?
The expenses at 75%.
Oh, you changed it to a percentage from 71.4.
Instead of 71.4.
Okay.
I like that. Tell me what
That's
you did
fine.
again.
Increase the expenses on the revised to 75%, so that would bring to the value of 14,708,000 on the expenses. The NOI would be 4,902,000 before FF&E. After FF&E, it's 44,020,000. So the final value after personal property is 46,092,600.
Jose, what'd you use for total revenue?
Same.
All the same,
Same.
19,600,000.
And they're both in
Okay.
agreement on that, so I.
Okay.
Yeah. Funny, in this case, all the constituent numbers were fine, and the bottom line I thought was out of whack. The last one was the opposite.
I was actually higher.
Mark, can you look at that?
Yeah.
Okay, all right, Mr. Panorama.
Okay, I'll move that we reduce the assessment to 46,092,600.
Yeah.
And that's based on increasing the expenses on the revised assessment, 75%.
The motion and a second by Mr. Hoffman. It's the same team here.
Mhm.
That's
That's what happens when we sit together.
So motion and a second to reduce, all in favor? Aye. The assessment is reduced to 46,092,600 based on increasing the expenses on the revised assessment to 75%. Thank you, gentlemen.
Thank you, Roman.
You too.
Thank you, Chris.
Thanks, everybody.
Okay, does anybody have anything else? No? Okay, we will stand adjourned then at 10:02. Reconvene next Wednesday, July 19th at 9 a.m. Thanks, everybody.
Have a good one.